last time we saw our next guest in late January, the 10-year was sitting right around 1.6%. Since then, we've seen an emergency rate cut by the Fed, and the 10-year fall to just above 0.3%, if you can believe it. That's hard to even imagine. This morning, the 10-year is yielding 0.718. Joining us to talk more about the fixed income market, we're joined by Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock, where he oversees more than $2 trillion in fixed income assets. Probably been going up. Your fixed income assets have been going up when no one said they couldn't go up anymore. But the question is, people buy, it's a safe haven. How safe are these assets now, given that I mean, you can't, I guess we can go below zero, but it seems like there's a lot more room for rates to go back up than to go down at this point, right?
Yeah, Joe, you're 100% right. I mean, one of the things you got to think about in this environment is this is not normal. We're going to have, obviously, this is going to be a sharp decline in economic conditions, and then we're going to recover. We're going to talk about this. You know, we got to these levels. I don't know whether it's a month hence or 6 months hence, but we're going to talk about these levels. You're right. Rates should move higher. Listen, what the ECB has done in terms of negative rates, the Fed's not going to do that. The Fed's not going to go to a negative rate. I could see them buying a lot of assets. They're going to slow down their buy program, their tapering of their program that they don't like to call QE, their bill purchase program. But it's going to be a long time if we go to negative rates. But you know, we've shifted down the rate of where the normal rate of range of rates is, and it's going to be there for a while. But some of the things that are happening, Joe, are pretty incredible. I mean, the inflation market. We're going to get a CPI report that's going to show inflation that was running at over 2%. Yesterday, 5-year inflation break-evens were 68 basis points. I think they're now up to 78, 79 basis points. This is pretty historic stuff. But what people have to think about is this is temporary. And, you know, how much do you want to own these rates here? You know, we've been selling some of our interest rate exposure recently, including today. And, you know, these rates are not normal interest rates. By the way, could we go a bit lower first? I think so. You could see 55, 50 basis points in the 10-year note, but boy, you over the medium to long term, these are rates that are going to be in the rearview mirror.
What did we use to before that book, Perfect Storm? What did we use to call things like that? I don't know. It's like, remember, mother of all. What did we use before that? I don't know. But I mean, so oil. You already got these unbelievably low rates, and then oil goes down 30% in a day to below $30 on top of everything else. It's weird that you see so many, and they're not all related. They're related, obviously, to some extent, but it is crazy that there are so many things around to push rates down that I don't think you could have ever foreseen this. Could you, Rick?
No, I mean, no. And you have a bunch of people are out there saying, you know, I told you this was going to happen. Really, I don't think anybody really predicted that you would see this sort of pandemic that's gripped the economy globally and, quite frankly, is shutting down. When was the last time we've seen this where you're shutting down whole businesses for an extended period of time? And we know in the U.S. that we are not close to peaking there. You look at what happened in China, where it happened and then it peaked. And we're probably, you know, what it's hard to say. Are we 2 weeks, a month away from that peaking dynamic? So, and like you say, you know, and then you get the oil dynamic simultaneously. Now, some of that is obviously demand-driven for sure. But, yeah, it's a bizarre set of circumstances. And I think one of the things you got to think about, people say you just got to go away. You know, one of the things you think about the range, I think Becky called it a roller coaster. I don't know what the tallest roller coaster in the world is. I think it was in Ohio or something. Yeah. But this is pretty incredible. Some things you're going to want to own 3 to 6 months hence. You got to start picking away at those.
I think the biggest thing to try and figure out is how severe of the economic impact is going to have, and how severe of a crunch are we going to see. Will authorities really shut things down the way we saw in China or not? And it's kind of confusing when you talk to the local authorities like we've been doing here. There's not federal guidance that says this. The local authorities are doing things kind of catch as catch can. And they'll admit to you when they're talking to you that, yes, we know that really if we were trying to protect as many lives as possible, we'd be doing this. But it's too much of an economic kick for us to kind of do that just yet.
I totally agree. Listen, I mean, part of when you think about managing money, you think about the economic paradigm ahead of us. The news flow is probably going to get worse before it gets better. Right. And you got to think about what that means and the depth of this. I mean, I literally don't recall. I mean, 08, I guess, is a reasonable comparison where we are today. But I would argue 08 is different because you created what was a long-term. This is going to be, you know, pretty deep. And then, quite frankly, let's talk about what Italy's doing. You talk about 1% of GDP. You think about I'm less concerned about monetary policy today. And, they're going to the Fed will take rates to zero, probably do it over the next couple of meetings. If you take a 1% of GDP and you put it into the system over a short period of time, think about it in the U.S. If we get fiscal policy that's of that sort of magnitude over a short time period, that's pretty powerful. But that's also what we need. And the markets, until we see that, the markets are going to be tough.
It just occurred to me, it's not about the depth of the slowdown. We could shut things down for a month and have negative 4% for a month. It's the duration. That's the most important thing we need to know. And things would snap back really quickly if we got a handle on this, or who knows how this finally resolves itself.
Inflation protection against this. But you think about what drives inflation in this economy, and it's more of a service-oriented economy. And you think about shelter, and look at what's happening to interest rates, and look at what's happening to the housing market. By the way, you look at some of the home builders today, I think it's pretty interesting from an equity point of view. If you think about what that is, and you think about where service inflation is, I think the lowest we've run in the last 10 years is 1.6% inflation. As you get to the backside of this, particularly if you get significant fiscal stimulus. By the way, not only getting fiscal stimulus, if we're going to pump more liquidity in the system, boy, it's pretty hard to see a paradigm where inflation is going to stay at such historically low levels. So we think it's going to trend up. But listen, we don't think inflation is a big problem, and we think the Fed can keep rates easy. But are you going to pick up from these levels? I think so, yeah.
Do you care about the form of the fiscal stimulus? I mean, some of the things they're talking
100%.
about. Okay, so what should the fiscal stimulus look like as far as you're concerned?
Yeah, I mean, listen, the way Joe described it is right. Let's say this is a sharp deceleration, you close businesses down. The fiscal stimulus has got to be tremendous amounts of money that goes into state and local governments that can turn around and functionally fund some of this state of emergency paradigm that's being presented out there. Short-term business lending, small business lending, I should say, but in a short-term nature because of supply chain breakage. If that gets in there, that is really significant. Things like tax holidays, things like unemployment insurance that get at people that are quarantined.
Payroll tax cuts being made permanent. I haven't heard anybody who's advocated for that.
Yeah, I mean, I think tax cuts can help, but I would argue there's more of a temporary dynamic that's really going to impact the economy. You got to get at what is a sharp deceleration, and what are the things that bridge you from here to there, and that's what markets will focus on.
Right. Well, at least you got your stupid Tesla, even that oil's going to like 50 cents a gallon, but you're going to be paying, I don't know how much you're going to be paying to charge that thing up eventually. No, I'm kidding. We just know how much, we know you love your Tesla. I love Tesla too. I love Elon Musk. I love everything about it. So I was just kidding about that. I want to needle you with that. Anyway, thank you.
No,
go ahead.
Thanks. Yeah. No, I was going to say, you think about what you described. Energy's in a structurally different place. Tesla is an embodiment of that. It's just different, and it means that energy, we can bounce from here, but it's a long-term secular decline.
Yep. All right. I wasn't asking you to talk about that. I know you don't want to talk about it, but I was just needling. Anyway, thanks, Rick.
I understand.